Somebody's son asks, can you explain how people borrow against their life insurance and which policies are ideal for doing this? Good question. Let's talk about it. Now, there are multiple different types of permanent life insurance policies that you can leverage and borrow from. I'm really going to talk about one, but I'll reference another one, and there are others outside of that one. So, the original vehicle was a whole life insurance policy, right? This is typically a vehicle that ultra wealthy use to leverage their money, and they can borrow from it and have double utility to it. These are two books that I would recommend for you to read. And they both basically talk about historically how these well-known companies, entities that exist today, leverage life insurance while they're alive to compound their wealth and use it as a super bank to invest into other business assets. Then something beautiful happened in 1997, where Index Universal Life was birthed. And the reason why it was birthed is because they wanted to see more compound interest from life insurance, but still also guarantee that you could never lose any money. So basically, just imagine if the stock market and the banks had a baby and outbirth Index Universal Life. The biggest difference between this and a whole life is that your money is actually being linked to the stock market. Whole life, you can get a set growth percent, 3-4%, etc. Versus with the IUL, your range can range 0 to 12%. The average is 6 to 9%. There are some index strategies that have no cap. So basically, how they do it, say you have money that you've been putting away inside of your policy and it goes into this cash value bucket. And the other component of the money you're putting in is going towards the cost of life insurance. Because yes, you're still paying for life insurance because that's the vehicle. Now let's say you have $200,000 death benefit and you got $100,000 in your cash value. You're like, hey, I want to go touch this money. I want to leverage it. There's really two ways you can access that money. The not so smart way is to withdraw it. After you withdraw the amount that you put in, you have to start paying taxes. The smart way, which meaning people are like, why would you take a loan from your own money? You're actually not taking a loan from your own money. You're actually taking a loan from the life insurance company. So let's say you want to borrow $50,000 from the life insurance company's money. Depending on the type of loan, whether it's fixed or variable, wash loan or index loan, all depends on your strategy that you pick. But basically how it works, let's say you borrow that money from your policy. What happens is they're going to use your death benefit as collateral should you not pay it back. And that 100,000 that's in your cash value is going to continue to compound as though you never touched it to begin with. Versus if it was just in a bank account, you'd have to liquidate your bank account by $50,000 in order to go purchase that asset. Versus in this case, you have 100,000 still in your cash value, and now you have 50,000 that you can go utilize, invest, and do whatever you want to do with it. And because you decided to take a loan, you can access it 100% tax free. Now, there are a lot of stipulations to this plan, which is the reason why I highly encourage you to sit down with a licensed professional and also do your research. Because if these plans are not properly structured, funded, and maintained, it can absolutely be a nightmare for you. Hope it helps. Sheesh.